So I think he's got a very balanced approach, and it's understandable if we think about, the kind of move we saw in the US 10-year from December 2019 to June 2020. It was a dramatic move. It was in response to the stress of COVID-19, reduction in rates, huge amounts of stimulus. And essentially what we've done over the last 7 months or so is retrace up to just over 60% of that level. And that retracement is an indication of a shift in financial conditions, in an improvement in growth and inflation expectations. And again, I think the important thing to note is that the Fed has not, anywhere in its policy suggested it will suppress all financial conditions. It has a target for price stability and for employment. And again, when we look at the detail of inflation, core inflation is still somewhat low. So the indication at the moment is that this is likely to be transient. And in the medium term, it's yet unknown whether we will have persistent inflation. In terms of the markets, and I think the markets tend to pick on, something topical to have a bit of a setback. We were ripe for a correction in some instances. If we think about the speed and the magnitude of the move that we've seen across global equity markets, and over the last few weeks, if anything, we've actually had very good fundamentals. We've had really good earnings, particularly if we look at the S&P 500. Over 80% have now released earnings, and 75% have been positive. So the fundamentals there remain good. I think if anything, this is an opportunity to buy on the dip.